All right, we're going to go ahead and get started. So welcome, everyone. We're so glad that you're here with us today. Today, we're going to be talking about 3 KPIs every growth stage founder CEO needs to know about for building a resilient software business. Now, this is part of Insight's ScaleUp CEO series, where we bring in our Onsite team, which is here with us today, different leaders from our Onsite team, and they're bringing their expertise and helping CEOs and founders that build their businesses the best way possible. So we're going to go ahead and go to the next slide here. And before we begin, I do have a couple of housekeeping things for you. So the session's being recorded. So if you have to leave early, maybe you want to share this with a friend, don't worry, it's going to be recorded. We're going to send that link to you within 24 hours. And if you guys have any questions, please do submit them. We pulled a lot of your guys' great questions you submitted in advance. We're going to be highlighting those today. And then there is a survey at the end, and we would love if you guys took about 30 seconds to fill that out. Make sure we give you guys the best content possible. So with that said, I'm going to turn it over to our wonderful presenters that we have today, starting with Hillary.
Hey, thanks so much, Deanna. Hi, everyone, and thank you for joining us. My name is Hillary Headley. I've been with Insight Partners about a year. Prior came from operating lives working in multiple companies like Zoom, Mindbody, and Ultrix. But I'm excited to introduce the main speakers of this event, which are really Jeremy Donovan and Charlie Gallagher. Jeremy Donovan has more than 20 years experience in operating as well, including some consulting, and brings just a wealth of information from the go-to-market side, but has been doing a series of speaking engagements with CEOs and founders, just like you all who've joined in. He's joined by Charlie Gallagher, who's one of our most impressive folks here at Insight. He's been here 4 years, has talked with hundreds of our portfolio companies, and really seen some pattern identification in that time. Couple that with his prior operating experience, and we are really excited to talk with you about the KPIs that impact you. But first, we want to take just a quick deep dive into who Onsite is. So Onsite is a team of more than 100 folks who really have come together and mirrored the company structure that you have. From product to tech, to marketing, to sales, to success, to talent, we make sure that we are here to support the questions of our portfolio companies and to help them see as much success as we want them to have, like they do. If you want to go to the next one, Jer. And we do that through primarily 3 ways. We have some great research, content, playbooks, and benchmarking reports that we're able to share with on-demand learning in those times where you or your team want to self-serve. We have an offering called Ask an Expert, where you can give us a call and Jeremy and I might jump on for an hour and answer the questions that you have or validate maybe a concept that you're looking to do. And then we have transformational engagements. And over those 4 years, I mentioned that Charlie's been here. He's done a lot of these and is going to be bringing that through and sharing a story or two. These are kind of a couple 100-hour engagements where we really flex for a couple months and make sure that our companies have the support, again, that they need to succeed. Last but not least, everybody loves a good coverage map of what are the things, if we have a question, might you talk about in Onsite? And this really gives that end-to-end view from go-to-market strategy and design through to effectiveness, execution, tech stack design, and then of course, those cross-functional dependencies with those partners that I talked about, and aligning with marketing, aligning with success, our product teams, and really across the board to make sure that you have what you need. With that, we really want to jump into the why KPIs. You can probably tell if you've seen any of us in prior sessions or on LinkedIn that we love KPIs and what they mean to a business. I'm going to have Charlie give a quick overview of why KPIs for this one, though.
Thanks, Hillary. Yeah, so if you think about it, the metrics that matter to building a resilient software business haven't really changed. You know, Insight's been investing for 30 years. Yet we continue to look at the same set of KPIs to see if a business gets us excited, or as operators to see where our portfolio companies need help. But what's changed is the business conditions that we're operating in. And in our view, what separates the good from the great is how you navigate those changes and deliver on these metrics. But lucky for our portfolio companies, they have someone to help with that on site. That's our team Hillary just shared a bit about. And we at Onsite and the market broadly have placed a considerable focus on efficient growth. You've been hearing that phrase again and again, efficient growth. But what does that actually mean to you as a founder or CEO? What do you actually measure to know that your business is on the trajectory towards efficient growth? So we're going to talk about how to define those metrics. And then once you're tracking them, how you can, get better. We'll share several ideas on what you can do to improve. And we'll also share some stories from our work with portfolio companies so you can see how real companies tackle these things, handle the current environment, and improve on these metrics. So, Jeremy, I'd love to pass it to you to break down that concept of efficient growth.
For sure. Well, as Charlie mentioned, the world really did change about a year ago. Before Q1 of 2022, we were all talking about, or at least maybe not talking about it, but thinking growth at all costs. And the data really supported that. If you looked at what was going on, and we're going to share some of that with you. And then, come Q1, Q2 of last year, we moved into a world where efficient growth was rewarded. And I think many folks were on a scramble to figure out like what is the right metric, top level, and then detailed to measure that. And then how do you actually achieve that? So that's what we're going to talk about today. To me, after looking at many different SaaS KPIs, the rule of 40 really is the absolute kind of personification of what efficient growth means, because on one side of rule of 40, you have revenue growth. So there's your growth piece. And on the other side, you have efficiency in the form of free cash flow margin. There are other ways to measure efficiency as well. But rule of 40, if you add those two things together, if you think about it, let's say you had a company with 50% growth and a minus 10% free cash flow margin, that would be 40, right? 50 minus 10. Or you could have a company with 30% revenue growth and plus 10% operating or free cash flow margin. And there you'd also have a rule of 40 company. So those two companies have the exact same rule of 40. They might actually have very different valuations now than what they might have had a year ago, because we're rewarding things, the market, I should say, is rewarding things differently. So one can deconstruct each one of those things into a variety of levers. On the revenue growth side, obviously, new logo acquisition, and which comes from pipe gen, is critical. And then expanding and renewing your existing customer base is the other piece. And today, besides the rule of 40, which I'll dive into a little bit deeper, we're going to look at net revenue retention as a metric. And then if we also look at the right-hand side, on the free cash flow margin side, there are a lot of components to free cash flow margin, again, rewarded differently over time, that each need to be managed by different groups. So obviously gross margin, sales and marketing expense, which is something we're going to dig into, where the key measure to look at is CAC payback, the number of months it takes to pay back your sales and marketing costs and your acquisition of new bookings. We're not going to talk a ton about it, but then the other pieces are R&D, and then what you're spending on your G&A executive functions. So let's spend a couple minutes digging a little more deeply into the rule of 40. And I'm an extremely data-driven person, as people who know me know, and I don't believe anything until I actually run the numbers. So like I saw this rule of 40 measure and I said, does this really apply? So we went and we pulled data for over 100 US public SaaS companies and tried to figure out what is the multiple. In this case, you can think of it as market cap, but we actually used enterprise value in the numerator and next 12 months revenue estimates in the denominator. You could use market cap over trailing 12 months revenue. There's lots of different ways that you could do this, but we used enterprise value over consensus analyst estimates for next 12 months revenue. So what is that multiple of value divided by the company's revenue? And just look at the two extremes. So if you had a company that had, let's use my example from before of, 50% revenue growth, but maybe they had minus 70% free cash flow margin. So, pretty wildly unprofitable. So that would imply a negative 20 rule of 40 statistic. So for a company like that, their multiple is a mere 3.7x. So not particularly rewarded for that inefficiency. And if we go to the far right, let's say we had that same 50% growth company, but they had 20 or 30% free cash flow margin, so both growing and generating free cash flow, then that company might have a 16, this is the median numbers, 16x multiple in the public market. So you not only see what you're seeing as a reward, but if you look at the trajectory of this, right, you're relatively flat. And then once you exceed 40, and this is why it's the rule of 40, once you exceed 40, you're getting a non-linear increase in the valuation multiple for those companies. Again, median for US public companies. The other thing we looked at just to validate this whole, like, how have we moved from a growth at all costs to efficient growth, or how has the market moved to rewarding efficient growth? What we did was we looked at what is the correlation of those multiples to the subcomponents that we showed earlier of the rule of 40. And in the period before Q1 of 2022, there was a strong correlation, positive correlation with revenue growth. No surprise there, growth and multiple highly correlated. But interestingly enough, back in that period, gross margin and CAC payback, that sales and marketing expenditure, didn't really have an impact on multiples in any statistically significant way. And if you spent more on R&D, you actually were rewarded for that. So again, like, that R&D drove revenue growth, so that makes sense. And then if you were spending too much on your executive compensation, you were penalized for that. So that one made sense.
Again, Charlie, why don't you dive into this one? And then there's also a question in the Q&A that I just wanted to highlight. So there's two ways that we can accept questions today. We'd love to put them in the question and answer. If you see that on your bottom bar in Zoom, right where typically you see the chat button, you can pop a question in there, and you can actually use that thumbs up so folks can upvote it if you want to make sure that we try to address it. Or you can share that in the chat slide, or in the chat side of it. We'll make sure to get that answer.
Yeah. So real quick, on the right-hand side of this slide, you have two companies who are both rule of 40, right? One has 30% growth, 10% free cash flow margin, and the second company has the inverse, 10% growth, 30% free cash flow margin. The former was rewarded in the interest rate rise environment, and the latter has a higher multiple today. So this is using the data that efficient growth is rewarded disproportionately these days. Let's flip to, okay. I think we need to get the deck back up. Sorry, folks. Okay, great. So should we jump into NRR, or Hillary, was there a question we wanted to get to?
So we'll come back to it. I think we should jump into NRR, and I think it could be a good framing up. It's around kind of product market fit as it relates to that, and execution and rule of 40. So let's maybe jump into the NRR side, and we might be able to swing back up. There's more questions coming in, which is awesome. Upvote those ones you want to make sure that we hear. So we'll jump to NRR. Jared, can you jump off mute and see if we can hear you now?
Yep, I am back.
Perfect. There we go. All right, Charlie, take it away on NRR for us.
Absolutely. So let's start with the definition, right? NRR is the percent of recurring revenue retained from the prior year, including the impact of upsell and cross-sell. If you go to the next slide. And the formula, right, is for our benchmarking purposes, starting ARR plus expansion minus downsell and churn over starting ARR. But in your business, we would recommend you calculate it on a cohorted trailing 12-month basis. So for all the customers paying me exactly 1 year ago, how much are they paying me today? And NRR from, as investors, is a really, really special KPI. It's basically an all-in-one summary of product market fit, of customer happiness, and of organic revenue growth potential. So, as investors, we like to look at how it's trending over time as you sign up additional cohorts of customers. But if you think from kind of a financial or P&L perspective, NRR is like a super accelerator metric. Small increases in NRR compound to have, exponential results. So for instance, all else equal, if you have two companies, one with 120% NRR and one with 160% NRR, which is phenomenal, off the charts. The second one will actually be 4 times larger than the first one after just 5 years, all else equal. So beyond that revenue compounding effect, Hillary, I feel like, there's also this other element in terms of efficiency, right? Expansion revenue is actually way more efficient and profitable, quote unquote, to acquire than is new logo. So, those are just a few reasons why we as investors look so closely at NRR.
think that's great. Jeremy, now that your mic is working, do you want to jump in and share some of those items around NRR that maybe you're seeing and why we track this so closely
Yeah,
as
I mean,
operators? That was a great, Charlie, thank you for the investing side of it. Jeremy, maybe kind of flip it over to the operating side, why we look at this, how we can improve it more importantly.
for sure. I mean, I think, right, some things are leading and some things are lagging indicators. This one is in some ways, I guess, a bit of a lagging indicator, but what is it a lagging indicator of? It's a lagging indicator of the fact that, number one, you have product market fit, right? Your customers are getting value. That's the retention part. And then they're not only getting value, but they're actually expanding with you because, they're able to get more value. And on that second piece, it's also a sign that you have figured out a way to participate in the value creation that you have with your customers. Whether that's through like usage-based models, or whether that's by adding additional users, whether that's adding features and functionality. So I think it's just a great way to understand that you're creating that value, and it really means that your product, your customer marketing, your sales, your customer success, all of these things are operating in harmony.
Thank you, Charlie. I know I mentioned at the beginning that you've been working with quite a few of our portfolio companies. Can you maybe share a couple of examples of what you've seen when improving NRR has come up as a challenge that a portfolio company wants to solve, and maybe some of the things you've done to help with that?
Yeah, of course. I mean, the first thing, and this is not a surprise, it starts with designing and staffing a customer success team, right? And the way we think about the jobs to be done, there are 6 broad things you need to do after you close a customer, right? There's onboarding and implementation. There's technical support, adoption, health tracking, commercial expansion, and renewals. Those are basically everything you do after post-sales will fall into one of those 6 buckets. And so, to you founders and CEOs and operators, right, ask yourself, who in your organization is responsible, dedicated to these activities? And do they have the right skill set and expertise to execute on those things that drive NRR? You can also look at their incentives, right? Are their compensation plans aligned to these responsibilities? I worked with one portfolio company. It was at about 50 million in ARR. They had a very good sales team. So pre-sales, they were closing deals, great productivity, but they had no single team that just owned retention and expansion or time to value. It was kind of like the tragedy of the commons, right? And so they were leaving a lot of money on the table, seeing a lot more churn than if they had these dedicated roles. So it starts kind of with org design.
Excellent. Jeremy, I know you were kind of excited to share something, and I think you've.
Yeah,
well, I'm just gonna let you share it because I think there's one way that you've always seen this that I know you want to.
One thing I would add is, I spent my career in marketing and product and sales, and I try to observe, what are the key drivers and what really works, right? There's a lot of people pontificating about things that work. And in many of the companies I've worked in, one of the best levers that companies have and underappreciated for driving net revenue retention is pricing. We saw this especially in the last year with companies changing from either no price increase or the standard kind of 3% annual price increase to people who are now tagging price increases to basically inflation plus, right? Or inflation, even just tagging it to inflation. So there's incredible opportunity, to drive NRR through pricing, especially if you have, high gross retention and your customers love you. And, even independent of what's going on inflation wise, packaging, even mere packaging changes can switch your destiny.
I think that's a great point. And I know pricing questions are one of the top questions that we get asked in our product and tech COE in those areas. When I was operating back in the day in customer success, and we've seen it with some of our teammates coming through here, we'll get the question of, we need to improve our NRR. How can we start getting better at renewals? And we sometimes like to rewind the tape a little bit for those of you who have a VCR background from the 80s and say, well, let's maybe take a look a little sooner. What's happening in your implementation and that first time to value? And there's been a couple workshops that I've been able to be a part of where I think everybody knows that, like in their heart, in their professional heart and in their head, that they should start with the minute the deal closes. We need to be paying attention to how fast they onboard, they see value, so that we can maybe get even some expansion before they renew. But rewinding that tape and focusing early on what those handoffs might be from your selling team to your implementation team to your renewal team could be a really great way to inspect and ensure that that positive NRR can come in not only through a renewal, but also with that expansion that typically sooner is better for those items coming through. Jarrett, there's a couple questions popping in, and I think you said you wanted to jump in on one of those live around CAC payback. Do you want to?
Yeah, from before. So one of the guests had asked a question about what do we mean by a negative correlation on CAC payback. So if you'll recall, starting in Q1 of last year, we switched to this efficient growth world. So CAC payback is, again, sales and marketing expense over net new bookings. So if it's taking you more months these days to actually pay back what you're spending to acquire business, then then your multiple is lower, right? So the more efficient you are in your sales and marketing to acquire new business, the more you're rewarded. So I just wanted to address that one.
Yeah. There's another great question here. It says, at what point do you find it makes sense to have dedicated expansion and or renewal roles versus CSMs doing it all? I'm like visually pulling up one of our best practices slide that our customer success team has. And I believe it's at that 10 to 50 million and the 50 to $100 million mark that you really start to look at an AM, or let's call that an individual who's going to be taking on expansion quota, focusing in that area from a CSM. We start to see like renewal managers come in that kind of 50 to 100 million, 100 million and up, especially if there's maybe a high velocity of renewals that need to be done that aren't evergreen but are termed. Or if there are just very large renewals that are tapped out, there's no more expansion that needs to be done. And that expansion opportunity needs to be shifted over to our AEs. I think we all know the answer to a lot of these questions is it depends. And so hopefully some of those dependencies, we can follow up later with what those might be. But there's a great snapshot. I see your name here. I'll try to send you that snapshot afterwards as a follow-up as well.
And I'll add, you hit the nail on the head on there are certain contexts under which, right, you put retention under a CSM versus a renewal specialist versus an AM. And for portfolio companies, if you reach out to us either on LinkedIn or after this, we have decision trees that can help guide where those functions should live.
Yeah.
And there's.
Oh, sorry. Go ahead, Charlie.
Oh, sorry. I was just going to say there's an exercise I like to do probably once a year. You just go on a whiteboard and you map out the customer journey from lead to close to expansion and renewal across the top. And then you list the different roles that you have or could have as the rows. And you can just sort of sketch out your coverage model in that way to make sure that you have clear alignment on who's doing what. So maybe sales engineers are responsible from like stage 2, stage 3 to close. Maybe they use post-sales too. Maybe you introduce an account manager to take expansion sales, where last year you had hybrid reps. Like just clarifying the roles and responsibilities alone and being super clear also on the input to that, which is the rep profile, the hiring profile of the person you need to do that job. You just sketch that on whiteboard. Can be so helpful and introduce clarity where you might not have it in your org.
Yeah. Charlie, that's I love that as somebody who's had to help run that in the past, and also tying that to compensation and goaling can be such a great way to make sure that you are tying up to that annual operating plan for your team. There's another great question in here. It says, in the data set directionally, what percentage of time does CS own the upsell versus sales owning the upsell? We have a really strong post-sales benchmark report that we use, which we can, in the way that we'll follow up, we'll try to share that out. It might be searchable online. Sorry if I'm forgetting on that piece, but that's part of the research that we do at Insight on an annual basis. And the answer is it depends. And it depends typically based on what your annual contract value is going to be around that, and the maturity also then of your company. So we'll try to find that and share that with you to the individual that asked that question. I'm going through, y'all are awesome at questions. I'm making sure that we're keeping up here. I think this is maybe Charlie or Jer, I'll give this to you and you can pass if you want, but can you address the plain old fashioned, yet highly important profitability metrics and how that fills in?
Yeah, so I think the audience member is referring to just kind of net income margin as a net profit, but the profitability metrics that we consider are a few. So I think operating margin, right? Earnings before interest and taxes over revenue. Gross margin. If Deanna, if you go back to that slide on rule of 40, kind of how it breaks up. One more. There we go. Okay. So, working top down from the income statement, you have gross profit, which is every single, additional dollar you create, you have to pay this kind of 20 cents on the dollar or something like that. So it'll scale as you scale. And then below gross profit is, sales and marketing, research and development, and general administrative. And below that is then your operating profit. So your operating profit margin. And then, after that are a few things like interest and taxes and stuff like that, just minor things. And that's net profit. But, at the growth stage, I don't think we're going to look at net profit margin that much. I think we're going to look at CAC payback and rule of 40 the most, because rule of 40 tells you the trade-off between growth and burn. And CAC payback tells you very actionably where in your operating expenses you need to probably tighten things up, or if things are working, let's pour fuel on the fire. Now, we have tons of other benchmarks within other operating expense categories. Encourage you to go to our website. Our financial and operating periodic table will go into benchmarks there if you want to break down kind of profit margin by department or by line item. I hope I answered the question. There's a lot of old-fashioned profit metrics.
Well, we can't see them, so we don't know for sure if we did, but we hope that we did in that area. Charlie and Jer, if there's any other ones in the question you want to answer, I'll give you a chance to read through those. Otherwise, I think
I will address one other one, which is how do you incorporate transaction revenue that is incremental to your SaaS ARR revenue in your NRR analysis, right? So again, I'm going to make an assumption that that's about services revenue or non-recurring revenue. This analysis so far, right, that we're talking about is on obviously on the recurring revenue piece. In that's the world that we focus most highly on. Typically, we do very closely monitor for our portfolio companies what their percentage of revenue on services is. For the most part, we just want services margin to be or the amount of services should be no more than about 10-15% of their overall revenue, and then we don't have a super high expectation on what the profitability on the services margin should be. Yes, great if it matches your recurring revenue margin. That's very, very rare. If you're in the 0 to 30% margin, that's probably a reasonable assumption. A lot of times services, right, are a part of, they're kind of like a part of the way that you're delivering value to your customers. So they not that we want, I think that's the best way to say it.
Yeah, and just to add to that, I think this is a metric you should look at when you're scaling from 10 to 100, because you might be throwing a lot of services for free or at zero margin or low margin to get those early customers happy and get those testimonials. But if it starts to contribute more than 20% of your revenue, as investors, it's less, quote unquote, less scalable, right? It's way harder to go from 10 to 1,000 TAM than if you all the other people you have to hire. So we have two channel experts on our team, Allison Sullivan, Claudine Lagerholm, who can help on channel. One of the things you decide on channel, besides feeding you leads and accelerating deals, is offloading post sales, right, to make your business more scalable. So as you build up your business, you could definitely be looking to offload services, especially if it's low margin, if you're optimizing for things like valuation, et cetera. So just a couple ideas.
Awesome. Thank you, Charlie. We have a question here, and I think we can probably move a couple of slides up. It says, I've seen CAC calculated in a variety of ways. What does Insight Partners really look at in their analysis? So that was going to be, as you saw on that first slide with the orange kind of call outs, really taking a look at CAC payback. So Charlie, why don't you kind of kick off how we define it, what goes into it, and then we can maybe get that question answered from the group. And thank you all so much for submitting your questions. That's fantastic to see these come in.
Yeah, so CAC, or customer acquisition cost, is your sales and marketing spend over a given period. The cost of acquiring revenue, right? But the CAC payback is how many months it takes to recoup that sales and marketing investment. And we measure that time in months. And the formula is you take S&M and you divide it by new and expansion ARR bookings, and then you multiply that fraction by 12. And CAC payback is, you know, we had a lot of trouble coming up with the 3 metrics growth stage companies need to focus on because there are so many, right? We debated it endlessly. But this one, as investors, is really exciting too, because it's the ultimate sales and marketing efficiency metric. There's no way to sugarcoat things, right? It tells a complete story. And so if you're wondering, you know, what exact value gets us excited, my business is here, my business is there, you know, it depends on the business, but if we had to draw a line in the sand, we'd say about 12 months CAC payback, or lower, right? Lower is better if you're selling into the mid-market or the SMB segment. And then if you're selling into the enterprise, 18 months or lower is good. And you might be wondering, hey, you know, why do we tolerate longer CAC paybacks in the enterprise segment? And the reason is that these customers typically have a larger customer lifetime value, which is, you know, a function of retention and other things. So it's worth spending a little bit more to acquire that customer because they'll be around longer. Conversely, like if you think on the opposite, you know, if you see a ton of churn, which you typically see higher churn in the SMB segment because solutions are less sticky, switching costs are lower, et cetera, you know, then, you know, you wouldn't want to spend as much to acquire that revenue if you're just going to churn it out in a few years, or even in shorter. And so, you know, again, putting my investor hat on, Hillary, right? We like this metric a lot because it tells me whether to pour fuel on the fire or not, you know, from an S&M investment standpoint. So if a company has a 30-month CAC payback, well, you know, I won't be as excited to double down on that business because the more you scale, the more cash you'll burn. Plus, you know, I'm not sure is that a sales problem? Is it a marketing problem? Is it a product market fit problem? All 3, like, but, you know, on the other hand, if a business is at 12 CAC payback months, well, you know, I'd be really excited to pour fuel on that fire and know that we'll grow efficiently.
Yeah, from an operating perspective, you know, Charlie had already mentioned this is you can't hide metric. I mean, I guess there are some other ways to think about how your business overall. For example, if you're in a product-led growth company, a PLG company, you might have to consider sales and marketing, a sort of expanded CAC, sales and marketing plus R&D expense, and look at that together, especially as you're comparing companies. But you know, I really love this because you hear so much about challenges in sales and marketing alignment. And from a CEO or CFO perspective of a scale-up company, this to me is like the measure that helps you align sales and marketing, because you're running an optimization exercise. You know, you're gonna want to drive as much inbound volume as you possibly can, up until the point where your marginal cost of acquiring a net inbound lead, right, is getting to be more expensive than your marginal cost of trying to source that as an outbound lead. And obviously those things play together. They're not completely distinct from each other, but you know, this allows you to allocate funds across the 2 of them and you know, stick to that efficiency target.
Excellent. There's 2 questions that have come in, which I think might kind of bounce these off real well. The first is just a clarification question. And Charlie, based on all the work you've done on kind of cost of sales and compensation cost of sales, do we include salary and commissions for sales and marketing in cost of acquisition as well? And this individual said many companies exclude them. Can you talk maybe a little bit about what you've seen or what you would recommend on the it depends answers?
Yeah, so commissions can be treated differently based on accounting standards, but the simplest way to benchmark this is to take your income statement, sales and marketing expense, and divide it by new and expansion ARR. Obviously the way you treat things, whether it's hitting the income statement this period or later, will change. Will potentially skew your metric, but it's not going to skew it enough that you're going to be drawing probably the wrong conclusions. And the second thing I'd say is there are other sales and marketing efficiency metrics that we didn't include, right? It's excruciating to narrow down to this list, but Insight, we recently published an article about compensation cost of sales. So I'll hit on that really quickly. It's, for every dollar of bookings that you bring in, how many cents do you pay all of your quoted teams or commercial teams? So, let's say your quota is $1 million and your reps on target earnings is 200K. You're paying 20 cents on the dollar for each, to your sales reps. But then you add sales managers, second line managers, BDRs, BDR managers, solutions engineers, CRO, maybe channel account managers, et cetera. So that's another way of looking at your efficiency, is to look at your compensation cost of sales. And if you want more on that or download the Excel template, check out our website.
Excellent. Thank you, Charlie. The one that I wanted to ping over to you, Jeremy, is should you or could you cohort your CAC payback per segment based on how we called this out here? There can be companies that obviously sell to very small business all the way up through enterprise. Jer, if you got that question from one of your portfolio companies, how would you kind of give them?
So like, can you and should you? Yes, you can, and yes, you should. I mean, at the end of the day, right, we're looking at overall corporate growth and efficiency. So, if you are, if your CAC is super high, for example, in SMB, you may have to have a very, very different strategy than you might have in enterprise or vice versa. So, I'm even thinking of one. Here's like an extreme example of a question that we got recently, which was, we have a company that has what they refer to as explosive NRR. So they land at, I don't know, 25 or 50K initially, and then within 2 to 3 years, they prove out the solution and they go to 2.5 million within 2 to 3 years. Like in that particular case, you're doing a very subtle, this is even more subtle than, the initial thing I said, you're doing a very subtle analysis, which is you might have a very, very high CAC on that one. And so you need to think longer term. So I'm hitting 2 of the questions that came in. One was that question. There was another question about like, do you, for this calculation, do you lag this or that, do you lag the sales and marketing expense, or do you lag the ARR bookings? And I this is another like answer of you have to tailor it to your business. So in that particular business, they're really looking at LTV to CAC over, a 3 to 5 year horizon. That may be appropriate in your business and in that type of business, but if you have a higher velocity business, then you don't need to lag quite so much.
Excellent. We have another question here, which I think could be a good one. And then I want to switch maybe to Charlie, an example I think that you have, and it's around what if teams implemented operationally to overcome the struggle to calculate go-to-market metrics on a timely basis and use them for decision-making. So I think in general, our answer at Insight is going to be, you have to have a process before you have the right tool to get the data. I also know there's maybe some ways that we've seen the process, some tools to get the right data. Jeremy, Charlie, you want to weigh in on anything that you think is ideal there?
I've done it a few ways, right? I mean, if to the extent that you can do this inside of your BI systems, right? If you have a Tableau or a Looker or what have you, go for it. There's an increasingly large number of companies out there, right, who are more out of the box. So we have an investment in a particular company, that does this in the sales KPI space called Discern. So if you're a portfolio company, we've got some programs to help you with getting those KPIs set up so that you don't have to invent everything from scratch in a BI system.
Yeah, and one thing I think about with these KPIs, like on what cadence do I review them, right? I think I've seen really good companies look at Rule of 40 in every quarterly board meeting, CAC payback, but since they're lagging, I think these 3 metrics more than quarterly is probably not that useful. There's a lot of leading indicators I would look at more often, like pipeline generation. I would look at weekly, for example, or conversion rates. The leading indicators, some of this stuff on a more frequent cadence, and then these lagging quarterly.
Yeah, if you want to get super, I mean, it's beyond the level of scope for this webinar, but if you want to get super sophisticated, right, on that question around quarterly KPIs with seasonality, right? I mean, absolutely, you can do that. Then you can use things like exponential time series smoothing in order to adjust for trend and seasonality to figure out whether you're on or off, you're on or off the trend.
Yeah. What I'd say about operationally owning it, and maybe you've been here as well, Charlie and Jeremy, I've been at a company where they've had 100 KPIs that were looked at every Tuesday, red, yellow, and green. That was a little too much. I've worked at companies that don't look at a lot of KPIs beyond, are we growing? And so of course there's going to be that mix in the middle, but some of the pieces that I think can come out well is not just trying not to confuse a KPI with a metric. So I learned it as every KPI is a metric, but not every metric is a KPI, which typically means there's a goal and a way that you're measuring it in red, yellow, green. So having enough KPIs that you're looking at with the leading and lagging metrics that maybe roll into that, and clear ownership on who really is going to be tracking it, be looking at it, and putting together the cross-functional programs to ideally improve it. And that's been some of the best ways to keep KPIs at the forefront, is with an owner and with action plans, because you'll quickly find out maybe some of those areas that aren't quite as understood, or that folks maybe aren't putting together the plans to improve those or to make sure that they are optimized and maintained. So that's some operational rigor that can come from a CFO's office, a COO's office, a RevOps office, whichever areas you really think those are best in there. Charlie, I'm going to ping it to you. I know you have a story from one of our portcos that really ties a lot of this together. So could you go through maybe a couple of those highlights and then maybe answer a few more questions? And we're already getting close to the end of the webinar. So I'm going to kick it over to you, Char.
Yeah, so we promised we'd tell some real stories. So here's one. This is super real. In terms of, a tough pill to swallow for this team. So, they were at about 80 million in ARR. And their CAC payback was pretty stable at around 8 to 14 months for several quarters, really good. But suddenly, it ticked up to like 21, 22 months. And the CEO came to us and said, hey, we're having, we have some ideas as to why our efficiency is taking a hit, but I'd really like Insight's point of view, sort of outside in, neutral. And we said, okay, let's start and double click on the data. So we looked at sales execution first, right? The denominator of this formula, the bookings. And they sold into the enterprise, they sold mid-market and SMB. And when we cut the data by each of those segments, right? So you cut CAC payback by segment, absolutely. When we cut the data by segment, we saw that 3 things were happening, and all of them were disproportionately affecting the enterprise business. So first, win rates fell from 58% to 37%. Average deal sizes declined by about a third, and sales cycles were longer by about 15%. And all of these things combined, to have a pretty significant impact on revenue performance. So, but it did tell us, where do we triple click? The enterprise segment. So then we at Insight, we looked at mega deals within the enterprise. And back when their CAC paybacks were efficient, the mega deals contributed about 2/3 of their business. But then these deals stopped coming in. They were slipping and they were getting lost. And that contribution fell from about 2/3 to 1/3. And also we looked at other things. We looked at win rate by pipeline source. Turned out SDR source opportunities, right? We're seeing win rates plummet and deal sizes compressing there. But as a result of all of this analysis, I think we provided 3 targeted recommendations to this portfolio company. The first was you should run a win-loss analysis on the top 10 mega enterprise losses, right? Like a kind of a retrospective. Why did we lose? Was it qualification? Were we not multi-threaded in the organization? Did our champion leave the company and the deal fell apart? What can we do, next quarter to avoid this happening again? So First is retrospective on mega deals. Second was upskilling the first line managers. The most underappreciated role in a company is the first line manager in sales. This is such a critical role. If they're not skilled, then the 8 to 10 people reporting to them aren't going to be much help either. But if they are skilled, they'll make 8 to 10 people more productive. It's like, such leverage. And if they're not, those teams aren't productive, then your CAC payback is going to suffer. The third was, arranging for our team, the sales COE, to actually interview a few of the reps at the company, totally confidentially, like no attribution to their name, but just to bubble up a few insights and themes as to, what's working, let's reinforce that, what's not working, so that we could get at the root cause of the issue in case, the quantitative data that you might run doesn't tell the full story. So I think that this really illustrates how Onsite works, Hillary, right? Like we can start with the benchmarks so that the CEO knows, this KPI is out of range, quote unquote. Then we can run analysis at arm's length to guide the CEO on where to look, to look more closely and get at the root cause. And then if need be, we can really roll up our sleeves and meet with the teams and go even deeper on the why and the why behind that, and then propose recommendations to remediate things. So you might be wondering what happened. This was early 2022. What happened after this? Well, they've really turned around the enterprise business. Their first line managers were upskilled. They're a ton stronger, and sellers' productivity increased as a result. And they actually beat their target in Q4, so later that year, and in Q1 of this year. So hopefully that story helps paint a little bit of a picture about how Onsite works with portfolio companies.
That's a great story, Charlie. Thank you so much for sharing that one. Jer, I think you had 1 or 2 other questions you wanted to maybe answer, and then I think it's maybe to wrap it up.
Yeah, there have been a few questions in here about transactional or usage-based revenue and how you would approach these types of things. And, it impacts, I think, more generally some of the calculation of these metrics. We also get a lot of questions around sales compensation, for example, for these types of models. So I think maybe, Charlie and I could probably both weigh in. Generally, you're looking at 2 things, right? You're looking at a minimum performance obligation, which is how a lot of usage-based companies report, and that is effectively like a fixed commitment that people have. So I would definitely add in the fixed commitment piece. And as you're calculating these things, right, these are not gap measures. So you're going to create a meaningful way that you're going to baseline yourself and benchmark going forward. So with a lot of businesses, they have the ability to either look back and do a 3-month moving average, or they can do a projection of what they think usage is going to be. So I would just apply conservative forecasting and estimation in order to come up with these measures so that you're able to track and optimize your business, right? I mean, at the end of the day, yes, there are benchmarks out there, but you ultimately want to benchmark against yourself and improve through understanding where the levers are and focusing on those levers that have the biggest impact.
Yeah, and I just want to hit that point about benchmark against yourself real quick, because so many people ask us conversion rate benchmarks, like funnel stage by funnel. It's probably one of the most common questions we get. And yes, we have the medians by ASP band. We can send you the data, but that's not the point. The point is, do you have an actual process, quarterly or monthly or something, where the management team looks back at how we performed last quarter, and by the end of the meeting, you have 3 ideas for what you're going to do differently next quarter. It doesn't matter what the meeting's called or who's in it. There's so many permutations of that meeting, but is it happening consistently, and are you actioning it so you don't make the same mistakes next quarter? And so your win rate, even if it's terrible, 1% win rate, can we get it to 2% next quarter? And so that's my guidance. I think a lot of CFOs like to get the number to put in the model, but just try and improve yourself incrementally and make sure you have a process to do that.
Yeah. I'm going to hit another question as well here, which is about cohort analysis, because I don't think we've really spoken to that on NRR. So there's lots of ways to do NRR. Yes, I'm definitely an advocate of doing cohort analysis. For those who are not familiar, what that means is basically think about each group of customers as an incoming class, if you will, or cohort. So you might take all customers who were signed in February of 2022, and you're going to watch how their expansion and retention evolves over the course of over the course of time. If you're on monthly, quarterly, or annual contracts, right, you can track that over time. And the reason that's important is you can then also, you can do a few things. One is you can compare the cohorts against each other, and you can figure out like if older or newer cohorts are trending based on like month 0 in a very different way. And if your newer cohorts are not doing as well as your prior cohorts used to do the same like number of periods in, then you need to make an adjustment, right? You figure out that something is up, somehow you're not delivering as much value. The other reason I think cohort analysis is important is another metric we didn't talk about that is kind of a pain in the butt metric, frankly, is lifetime value. And if you just assume that your average NRR is going to continue perpetually, that may not be true. So in order to forecast more accurately, if you put people in cohorts, you have a much better understanding of what their retention and growth trend is going to be.
Thanks, Jeremy. I'm going to ask for one final thought from both you and Charlie. I'll give you a minute to think about it since I'm putting you on the spot. I know I have one, and it's kind of from operating days of, like you said, Charlie, it was a really difficult exercise to pick 3 for this. There obviously can be quite a few, and these really feed into each other. But a helpful exercise, even just with your company, is to define what the metrics are that you want, define how they are defined in that area. It doesn't have to be a full data dictionary and through that kind of lens of like master data management in that area, but just really define what the inputs and outputs are. Get some of those owners, have them track it. And you might actually want to put some of those KPIs with a group that isn't historically the owner of those items. There's been in the past some really great ways that companies have been creative in looking at improving CAC payback when it hasn't included anyone from sales and marketing and what can be done in those areas. So define it of what you want to look at, define what goes into them, get an owner, be creative where you can. And it's always fun to make it a little fun for folks and include them at it to make sure that your business is running more efficiently and effectively as you go. So Charlie, Jer, hopefully that gave you a minute to kind of think through, and I'd love to hear from you, and then we'll take it back to Deanna.
Yeah, I figured since we're calling an audible on the summary, which I think is awesome, like what's one metric that we don't have in here that I think would be critical, right? Like what didn't make the list of the 3, and I think the thing that didn't make the list of the 3 but would be my number 4 is your target for pipe gen per salesperson. Actually, I listened to an awesome podcast this weekend, the Hunters and Unicorns podcast, and they had a guest on, Chris Singletary, who said like his thing is he uses this rule 36 24 6 4, and what he's doing for himself is every quarter and his team 36 net new discovery calls, 24 product demos, 6 POCs, and 6 POC planning conversations, and 4 POCs, right? And those numbers may be different, but like if you know what those numbers are for you, either per quarter, per month, per week, whatever, like that's critical to success.
I love that, Jeremy. I already made the point around, if you don't have a meeting to improve, come up with ideas to improve the metric, then tracking it doesn't mean as much. But one thing I'd add to that is like, today we gave you a dozen ideas for what you can do to improve on these 3 critical KPIs, but you can't do it all, right? So I would advise you to pick 1 or 2 and move those forward all the way to completion, and just start small and get it finished, right? And that's my parting advice, if you will, Hillary.
Excellent. Thank you, Charlie. There's 2 ways to keep in touch with Insight. The first would be go on our website, make sure you follow our blog. We also send out an excellent newsletter. You can follow or connect with us on LinkedIn. We do share all the great information that we can about Insight, especially if you liked it. And we're going to kick it off or send it back to Deanna, who really kicked us off in the beginning. So thank you, Deanna, for giving us the opportunity to speak with so many awesome folks in our founder and CEO arena. It means a lot.